Hi you guys, welcome back to the channel. My name is Brad. This is Firefly's Financial Toolbox. One of the best things about being on YouTube is the interaction that you get when you make videos. And in the finance space, there's no shortage of comments. And I got an interesting reply to a video I made on dividend ETFs for 2021. Mr. Berry said SPHD for the new savings account and SCHD for growth. And that got me thinking, right now, everybody knows that high yield savings accounts are yielding nothing. I get 0.5, a half a percent from Ally, and that's pretty much the going rate. So what about using ETFs for a savings account? So I decided first to Google SPHD as a savings account, and I came up with a couple of interesting things. First one I found was a Reddit post, and I'm not a normal Reddit guy, but I thought I'd read it. I'm going to read it to you guys. High yield savings accounts or ETFs? Hi y'all. This could be a dumb question, but is it better to keep my excess savings in a high yield savings account like Ally or into a balanced ETF portfolio? I currently max out my workplace retirement account and contribute maximum to my Roth every year. After both of those, I'll have about $3,000 a year that I could put into some other account. So is it better to put it in a high yield savings account or ETFs? I'm assuming the savings account is a bit safer, but with lower yield. Thanks. So here's what the first answer was. Of course the savings account is safer, right? But as we said, now this was a while ago, so it's showing a higher 2.2%. I remember when it was that high. That was about 2 years ago. Anyway, scrolling down through it a little, it says, everyone is pointing out that your portfolio should be based on your risk tolerance. But I think a key point is that your goals determine the appropriate degree of risk you can take on. If you have short-term goals, you should put the money in low-risk accounts. If you're saving for long-term goals, 10-plus year horizon, then you should generally use a higher risk vehicle that will provide a more substantial return. Great point. My goal is to consistently put money away and leave it untouched for as long as possible, possibly like another retirement account. I could see drawing down for a down payment on a home or other expenses related to my kids, but those are both 10 plus years away. All right, you guys, so that's a good point, right? If you have short-term goals, if you need the money in 3 to 5 years, it's probably not a great place to put it because, as you know, you could lose all of it. Any ETF that you invest in is going to have risk, and it has a risk of loss, right? Even your principal, you could start with $1,000, you could end up with $300. Now, that's a worst case scenario, but it is a possibility. And if the market's down at the time when you need to take that money out, then obviously this isn't the best option. But I found another, on Investopedia, I found another article. 7 easy to understand ETFs to replace a savings account. So this is not a new idea. If you have a savings account or a CD, you're probably not making more than 1% each year from interest. That's better than spending the money, true. But in order to truly grow in value, it has to perform better than the rate of inflation. According to the U.S. Bureau of Labor Statistics, the average inflation for 2019 was 2.2%. Most financial planners will use 3% based on the historical average. Now, investing in ETFs, in 2016, Charles Schwab found a study that 54% of investors plan to expand their use of ETFs in their portfolio. With these 1,400 plus product offerings, it's easy to understand ETFs have the potential to outperform inflation. To yield better results, you have to take on more risk, but some ETFs offer much lower risk than individual stocks. And we talk about that, right? If you put money in 3 stocks, you're making a bet that those 3 are going to do well. If you put your money in 300 stocks, you can have 3 that perform terribly and still not lose the bank. So it's certainly safer than individual stocks. But, and it says, over long-term savings account, it's going to do better, especially if you follow a large market index. So back to Mr. Berry's idea on SPHD. So SPHD is the Invesco S&P 500 high index, low volatility ETF. And the idea behind it is it's got stocks that are less volatile than a lot of the companies out there. So all these funds, and it says it will invest at least 90% of its total assets in common stocks that comprise that index. The S&P index have historically provided high dividend yields and low volatility. But if we read on in their thing, and currently right now, it actually, SPHD is trading at about $39 a share. So it's certainly a low price to enter, right? About $39 I could buy one share of this. Its 30-day SEC current yield is 4.59%, which is very high. So if we're reinvesting that money constantly, it's going to grow. One thing to remember though, if you are using it as a savings account, then that means you have it in a taxable brokerage account. And those dividends will be taxable in those years. So it's something to think about. Conversely, if you have that money in a savings account, remember you're actually going to have that interest taxed at ordinary income, where these shares most likely will be 100% qualified dividends, which is taxed at a lower rate. So something to think about. And depending on where you're at on the tax spectrum, that could be from 0 up to a max of 20%, right? So that could be better than having interest in a savings account at your ordinary income. But let's get back to the basics. The basics of this whole question is it a better option? Well, I think it depends on the person. If you're a young investor and you've already maxed out your tax protected vehicles, you guys, I think everyone should max out a Roth, period. If you have an employer plan, a 401k, a 403b, a 457, everyone should put at least as much to get the match. After that, it gets a little bit more confusing. If you have a really high expense ratios on all of your funds, then perhaps going to a taxable investment like using this for a savings account might be an option. Personally, I think it's better to protect my money as much as I can. My order of operations for investing is simple. Get the match first, right? So in my case, it's 5%. So I would always invest at least 5% to get that free 5% match, because I put in $1, they put in $1. Then I max out my Roth every year, and my spouse's. After that, then I go back and I fill up, in my case, a 457, but it might be a 401k, 403b, depending on what you do for employment. Max those out. Then when you have left over, then think about doing this as a savings account. Now, what I'm not advocating is putting your emergency fund in ETFs. You guys, an emergency fund needs to be in cash. It needs to be available so that if emergency happens today, you can take it out tomorrow. And depending on how secure your job is, the rule is 3 to 6 months, right? Full disclosure, mine's about 2 months because I have a pretty safe job and I'm not concerned about losing it. But I also have enough taxable investments that if I had to take more money out, I have those available. Again, the danger being if I needed that money at a time when the market was down, say the end of last March, I would be losing a lot of money that way. And the object here is to make money, not to lose money, right? Always think of the objective. If I didn't have to worry about spending that money for 10 plus years, then of course I would put it all in stocks. And ETFs to me are the best way to do that. For the general public ETF, buying a broad market ETF at S&P 500, or if you like the higher dividend yield, SPHD, I think could be a really good option for you. What do you guys think? Would you consider using an ETF like SPHD for your savings account? Or do you feel like that's completely unsafe? Let me know in the comments. I'm curious to know, because I think a lot of it depends on your age, obviously your risk tolerance, and what your plans are, what you're going to use that money for. That's ultimately what would drive the decision for or against. Let me know what you guys think. Put them in the comments. All right, you guys, I hope you enjoyed this. I actually really appreciate Mr. Berry for putting it out there, because it was a good topic. When I read that, I was like, oh my gosh, I want to make a video on that. I hope he's okay with it. So if you guys enjoyed it, do me a favor. smash that like button, turn it blue. It really helps get this video out to all my videos out to more people. If you're not already subscribed, I'm going to ask you again to hit that red button, ring the bell. You'll get notified every time I make a video. All right, we'll see you. Thank you.